Welcome back to the Real Estate Reserve podcast. Looking forward to a great episode. We're going to be talking with Joe Root. He's a multifamily investor out of the Chicago market. I can't say, Ian, that we have interviewed anybody out of the Chicago market, but definitely looking forward to this. If you don't know me, I'm Jason Balin from Hard Money Bankers, co-host of the podcast, Ian Horowitz from Equity Warehouse. If this is your first time tuning in, welcome. Promise we'll keep this a lot of fun, educational as well. If you're a return viewer, follower, listener, watcher, thanks again for all your support. We certainly couldn't do it without you. As you know, we like to bring in actual real estate investors, operators, folks and investors out there that are actually boots on the ground and, doing deals, every day. And, it's the funny thing about real estate investing is, a lot of people think of things on a macro level, but there's a lot of different markets in the United States. And there's a lot of different things that happen in all those markets. And not including that, there's also a lot of different asset classes that investors are investing in. So it's great to hear other perspectives.
Yeah, no, it's always exciting to bring in some new people and hearing their stories from all over the country. But like you said, in that micro niche market of where they operate. And guys, listen, it's not about us. Obviously we have nothing to sell. It's not really what we're here to do this for. We're here to actually talk to real estate operators that are doing it. So the best compliment we can give them is the shares. We don't care about the likes or subscribes. We don't make our money from running a podcast. We do this because we like it and we enjoy it. So guys, go ahead. It's the best compliment we can give our guests is that share. With that being said, just give you guys a little forewarning. Jason's experiencing a really bad rainstorm. So if he disappears during this podcast, it's not because he doesn't love us. It's because his internet or power went out because they're getting pummeled right now outside the DC area. With that being said, enough about us and let's bring in Joe. What's up, brother?
Hey guys, how you doing? Thanks for having me.
Yeah, man. Excited to have you on. Why don't you just give us a quick little background and introduce yourself to the audience.
Sure, absolutely. So Joe Root, my firm is East Superior Real Estate Partners. East Superior Real Estate Partners is the investment arm of Root Property Group. Root Property Group is a family business that's second generation. My parents started it in the 80s. We started East Superior in around 2014 because I had gone to business school, met a guy, and we had done some deals together and decided we wanted to do some more investing. We should start a business. So the business school is on East Superior Street in Chicago, and we named the business East Superior Real Estate Partners. A few years ago, we started talking to outside investors about investing with us. So it's been a long journey. Starting with the investments that I started making with the family and then with Bruce, my partner. And then now we've kind of evolved into having some third-party limited partners.
Nice.
And we are in Chicago. We invest in Chicago, multifamily. Had done a lot of value add, a little bit of development, kind of depending on what we see in the market at the time. But I'm glad to be here to talk about Chicago because I do agree there's not too many folks from Chicago that get an opportunity to talk about the market. And I think it's a really strong market. Is it somewhat of a hidden gem. So,
yeah, I mean, I'm out here in Philadelphia. I spent a lot of time down in Baltimore. Baltimore is a super small market, and you forget how big Philadelphia is comparatively speaking. But I think Chicago, aren't you guys the third or fourth largest city? I think you're actually bigger than Philadelphia.
I think we're still the third largest city.
Yeah, it's New York, LA, Chicago. I'm pretty sure is the rundown. So yeah, it is interesting that you don't hear more real estate talk coming out from that part of the country.
Yeah, I think there's been a lot of what we call headline risk around Chicago. So people hear about population loss, people hear about some of the crime, and then there's I guess just major metros in general have kind of been out of favor in the last 5 to 10 years. So we actually started looking to invest across the Midwest in Indiana, Wisconsin, Iowa, Michigan. And one thing that we found when we started looking at those markets is that Chicago was bigger than all of them combined. So you're absolutely right. It's a huge market.
Yeah, I mean, one thing that I kind of gather from just you talking and, looking at, doing a little research on your bio is it seems like you were from Chicago, you invest in Chicago. It's the only areas that you currently own real estate. I mean, I'm all about being a local investor. I think it's challenging to lend and invest in other markets. Like on your end, let's say you had, real estate investor in general. Like, would you recommend kind of staying in areas that you know? Do you think it's easier that way, or are you kind of like, hey, on commercial assets, multifamily assets, you really can invest in it, invest in any market, or do you think there's just major advantages of staying local?
I kind of ask myself that question a lot, because as we've thought about expanding into new markets, that's definitely come up. I think that staying local is definitely a strength. I think sometimes it depends on like the asset type or size that you're investing in. Like we're kind of middle market investors. And so in that space, buildings we're buying are between $2 and $20 million. I would say that's like a locals game in probably any market. So if we're going to try to invest in, let's say, Detroit or Columbus, Ohio, in that size building, I would be kind of surprised if we were the winning bidder, because we probably are missing something that the locals are not aware or are aware of. So I think in the middle market, probably staying local is important. But we do have expansion plans, and one thing is that we come from an operations side, so we've been managing properties since the 80s. And so we're really focused on our management business and how we manage properties. And so to go into another market, we probably have to give that up. And so that's another thing for us that we think about, is how do we asset manage other property managers that we don't have control over.
Yeah, real quick, one of the things I was thinking about, because you mentioned a lot of your stuff is between 10 units and 60 units in multifamily, but then it's 2 million to 20 million. So like a lot of people in different markets think of that as like your average per unit is a lot. It's expensive in general. And I guess so I'm guessing you're playing in higher end asset classes and nicer neighborhoods, because like you talk to people all over the country. We'll talk to real estate investors all over the country, and if they say, oh, I'm investing in a 30 unit building, like that might only be $1 million in some areas of the country. So which is actually a good thing. Like I'm all about, doing the least amount of units, the least amount of projects that cost the most amount of money. Yeah, no,
I sometimes think there's almost like a test of how successful your business is by how many units you have. And I sometimes like to go back to AUM or something like that, because I'm like, well, we don't have as many units as some other folks, but our AUM is probably similar. Because you're exactly right. Like we specialize in the north side of Chicago, which is what we call high credit areas. And so the per unit price is pretty high. Probably not compared to New York or Boston, but I think compared to some of the like tertiary markets for sure.
Yeah, that's an interesting point. Now, when you're looking at just quick math, 60 units could be $20 million. What's that, like $250 a door or something like that?
Probably more than that.
Yeah, I guess $300 a door is $18 million. Are we talking about are you investing in Class A assets all throughout Chicago, Class B, Class C? Like, what's your investment wheelhouse? And maybe even take it back to I guess your parents earlier out, because you have that interesting, unique story about being second gen, stepping into the business and kind of going down that road.
Yeah. So we I would say specialize in Class C and B, in B and A neighborhoods. So we're always looking at market rate apartments. One of the main criteria for us is there has to be pretty good median income in the area. And we know the Chicago neighborhoods well enough. So we just know this is a neighborhood where we're going to have tenants who have good jobs and are able to pay rent. What's kind of interesting, I think, about just the real estate market in general, especially in urban infill, like in Chicago, in these neighborhoods, there's not a lot of room to build more. So there's two types of products that get built in Chicago. There's luxury product, because the numbers make sense and it pencils out. And then there's subsidized low income product, and that makes sense because it's subsidized. But in the middle market, which is sort of where we play, like the Class B, and now I'm talking about middle market in terms of income stratosphere of our residents, they're not looking for luxury housing, but they also don't need affordable housing. They're kind of the middle class of residents. That type of product doesn't really get built because there's no subsidies, and it's so expensive to build in Chicago and probably in most infill markets, that stuff doesn't get built. And so there's a huge opportunity, and has been for the last, 20 years, to improve buildings that are 100 years old, and bring the finish it levels up to what residents expect today and what they need today. And there's a lot of things in these older buildings that you have to upgrade the electric. Like, they just don't have enough power for what we need today. Sometimes the bedrooms are really small because they were built for a different type of work class. And so that's basically been our strategy. A couple of years ago, we started to see what we thought about, like, from a risk adjusted return perspective. We thought some product closer to Class A was starting to look pretty attractive because it was stabilized and it was cash flowing in place, and we didn't have to do any of the work to get it there. And when we looked at it, we thought, okay, like, we could get about the same return buying that as we can getting a value add property, because so many people were still chasing value add and just didn't really want that stabilized product. So we bought a few of those, and those have done well.
Yeah, that's real interesting. And, presumably the way this Class B stuff comes about, either you improve a Class C property, because nobody sets out to build a Class C property, even LIHTC deals, right? They're waiting for some of that tax burden to burn off. They're not, they're playing the game to get the tax credits. Maybe that building becomes Class A later, or it becomes a Class B building because it's a nice product, or Class A buildings aren't Class A anymore and they get downgraded to Class B. That's how we get that product. Like you said, no one's setting out there to build that. And that's where we spent a lot of our time, was just building rental houses, doing the infill stuff all throughout the cities. How can you convert it? How can you work with the city? All that fun stuff. I guess talk to us, like, how you got into the business. I mean, I know it's a family affair. How'd you get involved? And, I guess, and kind of go from there,
Sure. Well, I have a younger brother who I work with, and when I graduated college, I got a job at another company in a totally different industry. I worked in finance, and my brother was 3 years behind me. He graduated college and went to work with my dad at the real estate business. And after a couple of years of kind of like working and doing the rat race thing in corporate America and seeing what my brother was doing with my dad, I decided that seemed like a pretty good option. So I left corporate America and came over and started working with them. This is back in 2006. And at that point, we were just managing a few buildings kind of for my dad and some of his like partners. And it wasn't much of a management business. So we then went through the GFC, and that kind of changed a lot for us. We started doing a lot of receivership work for lenders, and that grew our management business. We just had to expand our staff for that. So then as that started to wind down, we decided that we should become a fee manager. So we started managing third party property in Chicago. And that's under the Root Property Group brand. And so we still do that today. But then we were buying properties, my brother and I and our parents along the way, but not really to scale a business. Like, we had a decent business, but we weren't thinking about scaling or anything like that. So we weren't bringing in outside capital. But we were creating a lot of value for those properties and for the properties that we managed for other people. So then around 2014, I met my partner, Bruce, who we together started East Superior Real Estate Partners. And we put a small fund together with the two of us and a couple business school friends and started buying some more property. And then just probably 3 years ago, we decided that we were going to start raising capital for limited partner investments and I guess the syndicate model.
Nice. So so the majority of the stuff, so are you doing anything on the management side, or are you just self-managing your guys' current portfolio?
Yeah, we do fee manage.
You do fee manage stuff.
Yep.
That's what Root is. That's
what Root is.
Got it. But then your main core business is, obviously owner or operating your multifamily buildings.
Yeah, we've got a small staff in East Superior, and what we say our job is to source opportunities and to raise capital, and that's pretty much what we spend our time doing. Is
there one side of the business you like better than the other? I mean, there's there's obviously a lot of different moving pieces, as we all expand as business operators and, naturally extend into other lines of business throughout that, even if it's under one umbrella or if it's separate. But, there's obviously acquiring properties, there's raising money for properties, there's construction side of properties, there's the management side of the property. Like what side do you kind of enjoy?
Great. I mean, that's a great question because I think I enjoy things that I don't always do every day. Probably because it's just there's better use of my time. I really enjoy some of the underwriting and modeling. I don't do that as much as I used to, but I kind of enjoy like working on those things and figuring out some of the problems in a model. And coming up with assumptions that make sense, and sort of triangulating how we're getting to those assumptions. I find that to be interesting and fun. I don't do it as much as I used to. Today, I spend most of my time, I would say, on the capital raising side. It's something that I did my previous job before I came here, which was 20 years ago now. I was a placement agent, so I was raising capital for private equity funds. So it's something that it came natural to me. And it's, I think it's a sales role, just like sourcing opportunities is. So I also spend time on the sourcing side. Because we've been in Chicago so long, we have a pretty good network and know a lot of what's going on in the neighborhoods that we operate in. So, sourcing opportunities for us is just keeping in touch with people, making them aware of what we're doing and what we're looking to do. So I'd say what I do is a combination of sourcing capital, sourcing deals. But I do enjoy that quite a bit. It's kind of like the chase and the thrill of it.
Do you think it's harder to raise capital, harder to find deals? Currently, like if you had whatever unlimited capital, would you have not unlimited? Let's take that back. If you had $50 million of like dry powder, do you think there's enough deals out there? Or is it, hey, I have tons and tons of deals, but I can't do them because I'm just, trying to raise capital all day long?
Yeah, I love that thought process because we talk about it all the time. An interesting thing that I think about is I talked to my dad, like when you were buying buildings in the 80s for $30,000, did it seem expensive to you? And he's like, yeah, it did. Like it wasn't that much different than it is today. Like there was a NOI that was barely covering your debt service. It wasn't like they were buying it for $30,000 and making $30,000 a year in NOI. So, the market always evolves and real estate always appreciates. And I think one of the problems that I would have today with like an unlimited bucket of capital is what's the source of the capital. We have typically held things for a long time, and that's created a lot of wealth because I think some of the real benefits of owning real estate is through a long-term hold. And I think a lot of investors have gotten into this 5-year hold expectation that is fine. And I think that's harder to do today, especially at some of the returns that they're used to. And like people want a 20% return on a 5-year hold. I think that there's a lot of, it'd be hard to invest 50 million if that was my criteria and I had to make it cash flow at the same time.
Yeah. Wait, you're saying an LP would want that, or like the entire capital stack would want that?
I think there's a lot of LPs that want that. They want
in a 5-year time frame, they want a 20% annualized return.
Yeah.
Is that what you're saying? Okay.
Yeah. Yeah. And I think if we could lower that, I think we could find cash flowing properties that could put out mid-teen returns. Like I'm a pretty conservative underwriter. Like we always underpromise and usually overdeliver. And that's the way we're always going to be. So we're not like buying something at a 6 cap and then underwriting a 5 exit cap to make our numbers hit. Like that's not what we're going to do. And we're going to have pretty conservative rent growth assumptions, and they're always going to be backed up. Like we're always going to say, here's You can ask me about any assumption, and we can tell you exactly how we got to that and how we triangulated it and why we believe that that's the right assumption. And so I think we're kind of conservative underwriters. And mid-teens, I think in real estate is a pretty good return. I mean, I think it's a pretty safe asset class. And so I think some of these 20 plus returns that people have been getting are maybe just like,
well, yeah, I don't mean to cut you off, but like there was so much horsepower, right? From like that 3% days, people buying stuff at 4 caps. You could buy something, pretty much post GFC up until year 2, we'll call it 22-ish, 23-ish, where the market just went, that's it, right? There was a good 12-year run. And I mean, I don't want to say I got caught holding the bag, but like we're experiencing some things. An investor asked me yesterday, well, why'd you take 3-year debt at 3%? I said, when you're looking forward and you've had nothing but wins for a long period of time, you don't expect the debt to skyrocket from 3 to 7% and experience all these expense increases all at the same time. Like there was a lot of delayed, pent up inflation stuff that happened here, and it hasn't. I don't want to say normalized, but the buyers and the sellers haven't met yet, right? And there's still this like jammed log. And I think having that conservative underwriting, not setting insane expectations is 100% the correct thing to do. It's just, I think it's hard for a lot of operators. Well, I've always gotten 20% IRR. It has to work. It has to be this way. The debt has to go down. No, it doesn't, right? And I think too many people are unrealistic when it comes to setting that expectation and actually what their own personal expectations are as well,
Yeah, I agree.
So, well, let's talk about that. Where do you think debt markets are going? You seem to have a bit of a, sorry, Jay, I don't know if you're going to stay on topic, but I'm kind of curious on Joe's opinion. Debt rates, cap rates, inflation rates, everything that's kind of going on. Like, what are you guys seeing there locally? What do you think your expectation is over the next few years? And what are you guys sourcing or looking to buy?
Yeah. Well, the debt markets are probably one of the most important markets to watch, right? And I think there's a lot going on in the economy that could really, like, depending on the way certain things end up going, could have a big impact on where rates go. I recently did some research about the impact of some of the tariffs in the tax bill that could come out, and how I thought that could actually be something that causes a stagflation environment. So you could have inflation but slower growth at the same time, and that is not a great scenario. I think for real estate owners, it's actually not bad, especially for multifamily, because you have shorter duration leases, and so as prices are inflating, you can update your leases annually. If you're in a longer term lease, like commercial or retail, you might have more of an issue there. The inflation is not working with you. But another thing that comes up is a lot of people ask me about what I think is going to happen if the Fed cuts interest rates twice this year, I guess is the expectation. And I don't necessarily think that leads to a reduction in the 5-year borrowing cost or the 10-year. And people are surprised when I tell them that. They're like, well, if the Fed cuts rates 50 basis points, aren't we going to be able to borrow at 5% again? I said, not really. I mean, the way I think about it, if the Fed cuts rates, that could be inflationary, and you could have longer term rates rising a little bit. That's the way the yield curve is supposed to be. Short-term rates should be lower than long-term rates, and it got inverted for a while. And I think it's probably flattish today. But it should go back to a normal yield curve where you have lower short-term rates and higher long-term rates.
Yeah, one day it would be nice to get back to that scenario, because then things are predictable again. And I think that's the biggest thing about our industry that hasn't been over the past few years, rising debt costs. You don't know what the debt rate's going to be the next day. At least if we have some stability in the market, you can then predict. And I don't disagree with you on that statement, but I also believe that there's a ton of pent-up demand that will start to take action if they see these things, not necessarily because rates falling, but there's pent-up demand. We're starting to see it in the storage market. The REITs are coming off the sidelines. The private equity firms are coming off the sidelines. They're starting to get in acquisition mode again. That tells me cash is ready to flow because they feel as though something's stable or it's predictable. My bet's always been the first 18 to 24 months during this presidency was going to be wildfire. It hasn't been as of yet, but I do think at the end of the summer, we start to see people get comfortable, and there's probably a 12-month run. But, I don't know. If we were all predictors, we'd all be sitting on a private island doing this podcast. We would have flew you down in the jet, right? We'd all be sitting there, and this thing would be properly produced. And nobody has a crystal ball, man. All you can do is the best deal that's presented to you,
Yeah. Well, we've got to find a crystal ball. No, so like what we're looking at today with all of that said, and I agree that there's a ton of pent up demand. So we actually, what I think we've seen is as rates have risen, there's been a lot of negative leverage happening because cap rates haven't changed all that much. And I think that's because of all that pent up demand and just dry powder that's out there that is buying these things. So I don't think that real estate, like if rates continue to go up, I don't think real estate's going to take like a big hit. I agree with you on the pent up demand, and I'm happy to hear you're seeing the institutions come off the sidelines. That's great. But we're kind of looking at longer term debt. So like what I would love to find today is a property that has in place positive leverage and I can get 10-year debt on it. That would be great.
Is there one thing in particular after you got into this business that you think you learned between you started in 2006, right? And I was in the space then as well. Obviously a lot of things changed 2007, 2008, 2009, 2010. We all, I think, know the macro impacts of that, but in Chicago and multifamily, what was going on then during that time? I mean, was it hard to get capital? Was there, sweetheart deals that you were able to buy? Did your current portfolio suffer? Talk us a little bit through what was going on during those times.
Yeah. Chicago was again, it's such a huge market that there's, there are different things happening in different pockets of the city. So there were definitely some sweetheart deals. A lot of the best deals that I saw were single unit condominiums that were selling for like $25,000 to $30,000, and today are worth $300 something.
That's right.
Those that's where I wish I had bought some more of those.
Was that because there were so many condo delinquencies and people were walking away from their deals, so the condo assessments skyrocketed, and was that part of it?
No, I don't think that was it. I think there was a couple things happening here. I think there were developers that didn't sell out in time, so they got left holding some of these, and then they got foreclosed on, and so the banks were unwinding these deals. I also think that there were people who just couldn't afford their unit anymore, and so they're individuals going into foreclosure. I would say a lot of it was just foreclosure based, and I don't know that it was based on delinquent assessments.
Yeah.
I don't think. I think there were.
Yeah, because in theory, you have a 100-unit building and 20% of the people can't afford their payment. Well, they stop paying their their condo fees, and then someone's got to make up for it. There's only so much contingency for that, and we've seen, at least locally in our areas, there's condo and keep in mind you have newer buildings, and they're going down in value. So it's hey, I'm going to go jump ship and I'm going to be in the nice property, and the lower end stuff that needs improvements, lower end condos, typically, high rise stuff with elevators, big capital improvement costs, those are hard to retain because the costs are so expensive. And then you price people out. It's just like taxes, right? With condo association fees, you price them out of what they can afford.
Yeah.
in those particular areas. So I was just curious if that was the case, because we saw that as well. And I mean, we've seen condominiums in areas of DC and Baltimore and the suburbs that just still haven't bounced back.
Well, and we don't really do condos. We don't buy individual condos. We've never done a condo deconversion, but that's a pretty popular strategy in our space here. But I think that back then in pre the GFC, there were so many condos getting built, whether it was new construction or it was apartment buildings getting converted into condominiums. And most of those things now are 25, 30 years, getting to 30 years old, some of them. And so that's when they're starting to have massive CapEx needs. And I think a lot of these, especially like in the middle income areas, they're going to have issues raising the capital through their HOA to fix some of these major CapEx needs because they haven't been putting the reserves aside.
That's right.
So that's something that we're keeping an eye on is, are there going to be more deconversion opportunities because of that? Which is, we haven't seen too much of it lately, but we're not really in that space. We just kind of talk about lots of different opportunities.
Yeah, we've seen it, and that's the only way to save some of those things, is doing, converting it to an apartment building or something like that. We've seen, because it's like, hey, the unit owners can't afford these things anymore. We don't have money in reserves. We were about to do a loan that we ended up not doing the day of closing because the entire condominium building didn't have any insurance on the property, and they couldn't get insurance on the property. A few reasons with the insurance carrier, but more importantly is the homeowner association couldn't afford it. With rising rates, they couldn't afford it. And it's going to unfortunately be a downward spiral that was in early stages where someone's got to step in and cover that. And it's going to affect their unit owners, and lawsuits are going to start happening. Banks are going to realize that, the property that they financed, the unit that they financed is not insured anymore. And I'm kind of on the sidelines just watching to see what happens, because I don't know what will inevitably happen.
That doesn't sound like a good situation.
No. But if you think through it, like, you can see where that happens, like how that could happen. And, there was a nice famous building in Baltimore in the city. And if you look at comps, like, this is about 2 years ago, there's properties that sold for $400,000, and then there's resales that were like $100,000 in the exact same building. And the condo association dues and the capital improvement assessments, and it's skyrocketed. And like, people are just going to start walking away from these things, and someone's going to be stuck holding the bag. But and these are nice buildings. These are nice prominent buildings. Like,
plus you had Florida. You had all the stuff in Florida. You got that. They got required reserves now, and everything else that's going to be coming out. I look a lot at the beach towns, all the condo units, especially. You head south in Maryland, and you go out to Ocean City, Maryland, and that whole region. You look at a lot of these buildings going, there is no CapEx money in any of these. And if they do, they're not sinking it into it. At some point, they're going to have to do something. So, I think that condo market's going to be interesting. I like that. I haven't heard that one, but that deconversion idea is actually an interesting play to sit back and watch, because at some point, someone's going to have to, the one bank's going to say, hey, what are you going to do?
The unit owners will have to get together, through the association, and say, hey, let's fire sale this thing, and whoever's an active owner will split it up, and then we'll move on. And then the developer or the next person will figure it out. Like, to me, that's what the reset, how it reset. I think about like different assets resetting and industries resetting all the time, because it comes to a point where it's like, this thing's not sustainable anymore. What's going to happen?
Yeah. Well, there's like a life cycle to a real estate asset, right? Like, you build it, it's new, and then it kind of depreciates over time. And at some point you have to fix the CapEx. And as a building owner, hopefully you're planning for that, and you can use a refinance to take out some capital to rebuild the building. I think a lot of building owners don't do that. They actually sell at that point. So that's like something we watch for when we see buildings that need CapEx. We think they're probably going to sell. But a condo owner, especially in today's market where rates have risen, like, I think a lot of people took cash out when rates were low, and they maybe redid their kitchen or their bathroom, and now they have this big roof project, and they don't have enough equity left to do another cash out to pay for that roof, or their share of the roof. So, or they can't afford it because rates have gone from, 2.5% to 7%.
Yeah, well, that's the other thing. The condo association can't necessarily leverage that capital either. So it'll be interesting to watch. And that's a really good point. Normally at this point of the show, we would ask the guest a few questions, but I feel obligated that Joe should have to defend why Chicago deep dish pizza is actually good versus us out here on the East Coast that have normal New York style or Philadelphia style pizza. That's the real question here.
What's Philadelphia style pizza?
Oh, like New York style,
Okay.
like a normal pizza pie, So
Yeah.
I mean, I'm from the land of cheesesteaks and pizza, so but whatever, it's all good. So
well, there's a lot of deep dish here. I mean, you can find the flavor you like. So I think everyone.
I haven't been out there since I was a kid, man. But Joe, this has been an awesome conversation. Before we let everybody know where to find you on the internet or where to get the best deep dish pizza, what's one book or podcast that you think everybody should go check out?
Oh man, I've been reading a lot of books lately about like self-improvement. So there's a guy named James Clear who wrote a book and a couple books, and I think some of his books about like prioritizing your time. Those have been really helpful for me lately. So I'd look up James Clear.
Right on.
Yeah.
All right. And then Joe, where's the best place people can learn more about your property groups or management, and they want to see what you guys are doing, or they want to check out any of the investments that you have available?
Yeah. East Spear Real Estate Partners, our website is esrepartners.com. And I'm also really active on LinkedIn. So if anyone ever wants to chat with me, I'm always on there.
Right on. We'll get all that in the show notes. Joe, we appreciate you. Guys, it doesn't matter what type of pizza you like. This has been a good conversation. And the best compliment we can give Joe is by sharing the show. We don't care about the likes or the subscribes, but sharing it will go a long way and will help our brother Joe out. With that being said, we will catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.